Hi, everyone. It's February 2021, and I'm super excited to kick off our Home Buyer Club #1 with David Reed, who is a CRA Loan Officer with Citizens Bank. So, David's role within Citizens Bank is to try to reach first-time home buyers in most cases to see if he can help them figure out purchasing a home. So that's exactly the person that I want to connect people that have met with me with. So Citizens Bank has been a great supporter of the Mon Valley Initiative and our programming over the years. And we are delighted to have David and his information to share with everyone out there. Um, this evening. So, David, welcome. I appreciate you coming and spending some time to help our Mon Valley Initiative and our clients.
I appreciate that, Jonathan. Thank you. Like Jonathan said, my name is David Reed, and I am with Citizens Bank. I have been a loan officer for roughly a little over 2 decades. So I've seen a lot of different things and a lot of different scenarios. But tonight, when we go through our home buyers seminar this evening, we're kind of going to do some broad strokes. We're going to go over essentially the process of how you start looking and when you know if you're ready to be able to purchase a home. So we have here the first slide we're going to go through, and I'm going to first just talk a little bit about Citizens Bank and who they are. They are one of the oldest financial institutions in the country. They were actually established in 1871. Our corporate headquarters is in Providence, Rhode Island. We have approximately 1,000 branches in 11 different states, mainly in New England, Mid-Atlantic, and Midwest regions. We were ranked as one of the top 25 mortgage lenders in the country, and helping those first-time home buyers, as well as any home buyer, through the process and the journey of buying a home. And one thing that we at Citizens do and we care a lot about is we have a strong commitment to helping support and build our communities and within our local economy. So our goals here this evening, as we talk through essentially the process of buying a home, is we're going to talk a little bit about the advantages of home ownership, as well as some of the disadvantages. We're going to determine, or at least ask the questions to determine if you're ready to buy a home. You know, what kind of costs are you going to incur when you purchase a home? You know, what does the process of purchasing that home look like? You know, why is it important to get pre-qualified for your mortgage loan before you actually shop for a home? We're going to walk through some of the steps as far as getting your mortgage qualified, and then kind of walk you through all the steps of the actual purchase transaction.
Good, great.
Okay.
Good.
So let's start off just by talking about the advantages and disadvantages of buying a home. You know, one of the things we look at nowadays as far as an advantage of owning your own home is that more often than not, your property value is going to increase over time. And that is, you know, that's essentially like a little piggy bank for you, right? A little savings account.
Sure.
You know, you could potentially have some tax benefits that are associated with owning your own home. I'm not an accountant, but I do know that there are some things that you do get tax benefits with. For example, possibly the interest on your mortgage, as well as your real estate taxes that you pay on your property. All right. Another nice thing about owning your own home, you don't have to argue with anyone except maybe your significant other on how you want to decorate the inside of your home. Normally, when you rent, the landlord kind of tells you what you're allowed and not allowed to do. All right.
Or having
also,
a pet.
Yes, exactly right. Having a pet as well. All right. And, owning your own home is a little different than renting because you have that sense of stability and security, something that you can call your own. And it says here a degree of control when it comes to your housing costs. And that is mainly because, you know, when you rent, in some cases when you rent, it could include certain utilities. It may not include certain utilities, right? If you own your own home and you don't want to have cable, you don't have to pay for cable, okay? So whenever you look at some of the disadvantages of owning your own home, we look at, you know, there is an initial financial investment whenever you purchase a property. Okay. Also, if you're needing to, you obviously will need to move into your new home. And, you know, unless you have a lot of relatives and friends with trucks, you may incur some moving expenses that go on with that, right?
Yep. Yeah.
Another thing that goes on with when you buy your own home is that there's no more, calling the landlord to come fix the drain in the bathtub. Those repairs and maintenance fees and costs are going to be the responsibility of the homeowner. All right. As well as, you are responsible for paying taxes on your property. Okay. And then, the last one here, it says that, the value of your home may remain flat or go down. That is not something that happens a lot. However, it is something that could happen. When we had the mortgage bubble of 2006 and 7, that was a big issue, that we had declining property values. So that is always a possibility that you have to keep in the back of your mind.
You are muted. By pressing star 6.
Okay, so next question we have is, are you ready to buy? Well, these are some questions that you're going to want to ask yourself. What are some of your personal reasons for wanting to purchase a home? How long do you want to live in this home? Is this your starter home? Are you downsizing? Or do you plan on upgrading over the next 3, 5, 7 years? All right. How much money do you have saved for down payment and closing costs as well as your initial investment goes? And, what are you comfortable as far as paying a mortgage payment and still have your other bills that are associated with life, right? So these are all things that we want to ask ourselves as we kind of go through and find out, are we ready to buy a home? So we're going to talk a little bit about the expenses of owning a home. And it's not just the upfront cost of owning a home, but there's also reoccurring expenses that happen on a monthly basis when you own your own home. All right, let's talk about the upfront costs first. All right, traditionally, there's going to be down payment on your home. There could be closing costs involved, whether you have moving expenses, depending on what type of home you're looking for and what comes with it. You could have some major purchases, such as, appliances or a washer and dryer. All right. And depending on what else you're getting with your home, there may need to be some immediate repairs, whether it is a roof or maybe it needs new carpet or a hot water tank. These are all things that, you want to assess in the beginning processes. But then you also have monthly costs that go along with home ownership. These things are like, your monthly mortgage payments, okay? And a majority of the time, your monthly mortgage payment is not just going to include your principal and your interest, but it's also going to include your escrow account, which essentially includes your real estate taxes and your insurance premiums on the home. And depending on whether you're looking at purchasing a condo or a home in a planned unit development, there could be association dues that are associated with that property as well. You also have maintenance and home improvements, right? I mean, there's a lot of different things that when you go into your home, you may like the color of the walls today and not like them tomorrow. These are things that you can change, but that's something that you want to budget for in the long run, as well as utilities. So, unless you're purchasing a home in an eco-dome, there's electric, there's cable, there could be gas, all right? There's other utilities that are associated with that home ownership. Now, saving for a down payment and closing costs. A lot of people are...
Let me ask
you...
Go
ahead, Ron. Yes.
And it's certainly something I cover with people when we talk about home ownership. What do you think the number is that people need to save? Like if we were to give a percentage, so they're buying a $75,000 home. Do you have a number in mind that you tell people that they should target to have?
Realistically, yes. Whenever I go through this, obviously I talk about roughly needing about 8% of your total purchase price. Okay. So obviously the more you're looking, and this is without assistance. Correct. So there's other avenues that can help first-time home buyers, whether it be grant money or community funding and things like that. But if we're talking about anyone that's looking to purchase a home, all right, without any assistance, you want to save roughly 8% of what you want to purchase your home for. So if that means it's $100,000, you're looking at $8,000, right? If you're talking 200, so on and so forth. But as we look at the slide here, one of the things I want to say is a lot of people think that whenever they go to purchase their home, they need to put 20% down on the home, right? I don't have enough money saved because I don't have 20%. And in all reality, and this is not just for first-time home buyers, but it also applies to them, is that the minimum down payment requirements for most purchases are only between 3 and 5%. Okay, and a lot of people, don't recognize how much in reach that new home could actually be because they don't need 20%, right? You can look at putting 3 to 5% down, and it gives us a little example here, of a $250,000 sales price. 3 to 5% is $7,500 to $12,500. All right. But there are other programs that are also loan programs that are also there to help people as well. For example, a VA loan, which is a loan for veterans. Okay. And they could possibly qualify for no down payments, as well as there are other benefits that go along with that as well.
Right. And
Now,
I always
yes,
look at VA
go ahead,
loans as the golden ticket, David. If you know someone, if you're out there listening and you know someone who's a veteran who doesn't own a home, the VA loan is just such a great program to help our veterans acquire real estate. So if you know someone out there that's a veteran, and Pittsburgh's got lots of veterans in our area. So if you know someone out there that's a veteran, and I'm sure David would love to talk to them about what's possible, or I'd love to talk to them too, to help them see the benefits of using their VA certificate of eligibility.
well, continuing on after that, John, we want to look at, there's FHA loans. Now, an FHA loan is a Federal Housing Authority loan, which is essentially a government loan. Okay. Now, this government loan it requires only a minimum of 3.5% as a down payment for first-time home buyers. Now, the nice thing is that with this government loan, these loans are only available to people who want to purchase homes and use it as their primary residence. Okay, so these loans are not available to every person that wants a mortgage loan. They are reserved specifically to people who are living in the property that they are financing.
Yep.
Now, one thing is we look at the closing costs. Now, it says the closing costs can vary from 2 to 6%. This is going to be determined by the loan amount, but it's also going to vary by where you live, okay? And one of the ways I explain that is that whenever you buy or sell real estate in the state of Pennsylvania, the state of Pennsylvania charges a tax for that, and they call it transfer stamps, essentially, which is the tax they charge on the buyer and the seller for exchanging real estate. Now, depending on where you live within the state state tax rate can be different. For example, if you were to purchase a home in Butler County, that would be a 1% transfer stamp, which is 1% tax of the purchase price that is charged to the buyer and to the seller. However, if you live in the city of Pittsburgh, for example, that transfer stamp is actually 2.25% to the buyer and 2.25% to the seller. So also, as a lot of people go out and look for homes, one of the important things that they look for is the school district. They want a good school district to be able to raise their kids in. Well, you're also going to see that depending on the school district is also going to dictate what type of school taxes you have on your property. And this is also, like I said, going to vary those closing costs as well as your monthly payment.
Yep. So a reminder to people that there are 3 taxes that we pay when we own real estate. So I'm in the city of Pittsburgh, so I pay Allegheny County. I paid tax to the city of Pittsburgh, and is my local tax, and then to the Pittsburgh Public Schools. So every community, you're going to have 3 taxes, and they're easy to look up, and that can help you kind of budget or plan on what the future might look for you in the area that you want to buy a home. So there's 3 taxes, and so we have to take into account all 3 of them.
Okay. So when we go to the next slide here, we're going to this is just kind of a checklist here of how the home buying process works. Okay. So one of the first things that you want to do is you want to get pre-qualified for the mortgage. Okay. And the reason why you want to get pre-qualified is because first of all, you want to know that when you start looking at houses, that you can actually afford the home that you're looking at, as well as you want a nice piece of paper to be able to present to a buyer or to a seller, letting them know that you are pre-approved if you so choose to make an offer on their home. Okay. And after you get pre-approved,
so let me have you back up, David.
Yes.
What does pre-approval look like? What is that process? Someone sends you a letter, someone calls you. How does that work? What's that time frame take to get a letter that says you're pre-approved?
That's an excellent question, Jonathan. So to get pre-approved, essentially, we're going to go over a multitude of things. We're going to go over your credit. We're going to go over your income, or your job history. Okay. We're going to talk about what is comfortable for you for a mortgage payment. And that's one thing that I do specifically, is that in some cases I can approve people for more money than they want to pay. Yeah. And so I kind of reverse engineer it from a standpoint of that if you're comfortable and happy paying, $700 a month in rent, you're going to want to stay within that window from a mortgage payment. Now, does that mean that you want me to issue you a pre-approval if you're $1,400 a month? Probably not. But what we do is we collect those pieces of information. We review that. I talk to you about your overall goal, besides of never having a mortgage ever, whether you win the Powerball or not, right? But then we talk about what that borrowing power looks like. So based upon each individual, we have an individual conversation. We talk about what their overall goals are, what their budgeting and expenses look like, where they would like to land. And then I am able to create, essentially, if this is where you're comfortable, this is going to be your buying power, whether that's $80,000 mortgage, whether it's $150,000 mortgage, that is determined based on our conversation. So we like to look at it as the 4 C's. So that's credit, capacity, collateral, and capital. So capacity and capital are essentially the money you have saved and the income that you make at your job. The collateral is the home that you would be looking for, and your credit. And we have some other slides after here, so we're going to do a little bit more of a deeper dive into some of these topics as we get through. So we're going to go through. So after you find your home, okay, and you're like, okay, this is it. This is the one I want. You would essentially make an offer to the seller to buy their home. Now, once the seller agrees to your offer, both the buyer and the seller will actually sign a purchase agreement. This is an actual contract that is essentially binding you guys to the exchange of this real estate. Okay. And then we have after we've done this, then we physically apply for your mortgage loan. And one of the questions I get a lot is, why do I have to wait until I sign a contract on a house before I actually apply for my loan? And the reason behind that is because whenever you apply for your loan, one of the details that is needed on a mortgage application is an address. All right. So until you physically sign a purchase agreement, technically you do not have an address. Okay. So this is our pre-qualified screen. We essentially talked a little bit about this already. It is not a very intrusive process at all.
10-minute conversation?
Yes. So it is a very simple conversation and process to be able to get pre-approved. Okay. Roughly, whenever we're talking, we could look at getting pre-approved in anywhere from 20 minutes to 30 minutes, depending on how long-winded I end up talking. So it's not very hard at all. All right. Now, this goes into a little bit about the mortgage qualification process and how the bank or the lender is going to look when we review your application. We're going to look at your ability to repay the loan. So we're going to look at 2 things there. We're going to look at your credit and how you've handled other credit obligations, as well as what kind of income stability you have. All right. We also, something that's very important is also the market value of the property. Okay. Now, this is 5 key considerations for qualifying for a loan. Now, this is kind of like the circle of 5, but the slides after this are kind of break down a little bit more in detail how we come up with some of the things that we come up with through this, all right? This is just going through, like I said before, your employment, your income, your debts, your credit history, and the appraised value of the property. Now, what do we ask you about your employment history? Well, how long have you been on your job? You know, how long have you been in your occupation or doing the same line of work? Now, this is something that that probably most of us have had in the last 2 years is gaps in employment. Okay. And that is, you know, particular because we're, you know, just learning to live outside of the pandemic world. And, you know, it was just almost a year ago that we were essentially shut down for 60 days, not able to do anything. Now, just so everyone is aware, everyone has gone through this. So it's not about, oh, well, I was laid off for COVID. I can't buy a house because I had a gap in employment. Okay. The once in a century pandemic is almost like the exclusion there. When they say gaps of employment, what they mean is, did you hold a job for 3 months or 6 months and then you took 6 months before you got another job, right? Or maybe you went back to school. So these things don't eliminate you from being able to be pre-approved. More often than not, the lender is going to ask for explanation on why the gap of employment. Okay. Now,
So
go ahead.
what's your plan strategy if someone does have a gap in employment? What do you share with them to try to help address that? What's the game plan?
Well, honesty is the best policy. The way I go, and whenever they are looking for reasons behind gaps of employment, they want exactly that. They want to know why there was a gap. Because in reality, if we do not explain why there is a gap, we are going to show essentially less income being made, right? Because, for example, unemployment compensation is not something that is traditionally used in order to qualify someone for a mortgage. Okay. However, all right, you know, there are other things. You could have been hospitalized. Maybe you took time off for a baby. Okay. There are lots of viable reasons why you would have a gap in employment. Okay. So it's just identifying what those are and the reasons why. Okay.
Yeah.
So
and for the people out there, I think one of the things I've tried to share with people is come in to, you know, when you turn in your papers, turn in your letter explaining what's going on. And then that way, everybody that picks up your file from that point forward can read your letter and understand what happened to you. And I think that helps fill in some of those explanations that we don't want someone else to make on our behalf. We want to tell them what exactly has happened and with your employment. So if there are gaps, I think always the best strategy is come in with a letter right up front so that everybody that touches your file can see exactly your explanation. And that's what's important, that it's your explanation and not somebody else's. So sorry to interrupt you, David.
No, that's okay. So as we move through that, we also identify, okay, is there a co-borrower on your loan with you? Is there a significant other? Is there a family member? Are they employed? Are we utilizing any of their income in order to qualify for the mortgage? In addition to that, then, self-employed. Self-employed is a big topic because everyone questions on how self-employed works. So just to kind of steer a little bit here, whenever you are self-employed as a bank, they are going to look at, have you been self-employed for at least 2 years? Okay. So within that span of time, if within a 2-year span of time, if you were self-employed and essentially that can mean being licensed, you would have to be filing federal tax returns as a self-employed person. Okay. And we would be able to utilize that self-employed income in order to qualify. But that is a minimum that you need to be self-employed for 2 years minimum. Now, the other thing as far as calculating the amount of income a self-employed person makes, because I know I've dealt with a lot of self-employed, and the self-employed is like anyone else like us. We do not want to pay the government any more tax than we have to, right? So there are some things that kind of give self-employed people a little bit of leeway to keep that from happening. But what happens as far as how the lender looks at that there are some things as being a self-employed business owner that a lender is allowed to add back into your income. For example, when you're self-employed, you have depreciation of assets, whether it's vehicles or certain things like that, that the lender can actually add back in to help assist with essentially showing the real income you're making and not necessarily the income you're being taxed on. Now, I will tell you with self-employed borrowers that they will not just take a year-to-date profit and loss. So, for example, let's say 2021, you're gangbusters out of the gate and it's showing that you're going to make $10,000 a month. However, you only made, $30,000 in the year of 2019. So how do we get around that? Well, it's not necessarily getting around it, but what the lender will do then is they will average your income over that period of time. So they will take 2019, 2020, your year-to-date profit and loss, and they will average that to give us an average income for qualifying purposes. So these are just, this is going back into income, because whenever we qualify a borrower using their income, we use their gross income. Now, the gross income is what you make prior to taxes. So whether you're salary or hourly, whether you receive overtime or commissions, whether you receive annuity income or alimony, child support, it doesn't matter. Whatever that is before the government takes their taxes is what we are going to use in order to qualify. Now, the one thing here, as far as the last bullet point here, part-time or seasonal income, that is also a big question. Self-employed and part-time employment kind of go hand in hand. The lender knows that it's a part-time employment because we're stating that, So we, as a lender, want to see that you have 2 years history of part-time income. Okay, that doesn't necessarily mean that you have to be with the exact same company for 2 years part-time, but we want to show at least a 2-year history of your part-time income, and if you want to be able to use that income for qualifying purposes.
So seasonal would be like a lifeguard. You worked at Sandcastle and you work in the summertime and that's it. So you would need 2 years of that, David, to kind of average that out?
That is correct. There's also like landscapers who, don't have a plow, right? That essentially get laid off in the winter, right?
Ski patrol,
so
right?
These are all things like that. Yes. Okay. So when we bring up the next slide here, we're going to talk about expense ratios, okay? Because ratios are something that go into approving you for your mortgage. All right. So right here is kind of an example of what a housing expense ratio is. Okay, so we're going to use an average here of someone who makes $100,000 a year. Their average monthly income then is $8,333. Now, what we like to do as far as calculating your mortgage payment is that we want to keep that mortgage payment at 28% or below. Okay, so we look at that and say, okay, 28% of your gross income is $2,333. And this is where I kind of reiterate the fact that this is why I ask what you're comfortable in paying as far as a mortgage. Because, we look at this number and we say, oh, well, $8,000 a month, that's before taxes, okay? And to know that you could have a mortgage payment of $2,300, there are going to be people that are just not comfortable with that. So that's why we have that conversation and say that I can approve you for more than you want to pay, because it is quite possible. So when we go to the next one, we want to look at monthly debts as well. So this is also going to go into a ratio, but we're going to talk about them first. So we look at all the other recurring monthly debts that you may have. This does not include your cell phone bill or your utility bills. These are specific car loan, truck loan, leases, student loans, credit cards, personal unsecured loans. If you have an obligation for alimony or child support, These are things that we look at in order to qualify you, things that are normally reported on a credit report. Okay. So when we take both the housing expense and your other debts, we go and do this called a total debt to income ratio. Okay, so we add your housing expense to your other debts, such as your car payment and your student loans, and we essentially take that total number and divide it into your monthly income. So in this case, we're showing the total debt to income ratio is 36% in this example, which is essentially $3,000 a month from someone's gross income. Okay, now, whenever you get qualified for a mortgage, your total debt ratio, at least with Citizens, cannot exceed 49.9%. So essentially less than 50% of your gross income needs to be assigned to other debt, including your housing expense. Okay. So another thing that we're going to talk about, credit history. This is a big one because there's always a lot of questions around credit scores, credit history. Why is my credit like this? What are the things? Who are these people named TransUnion? Okay, so there are 3 specific credit bureaus that all lenders use, and that would be Equifax, TransUnion, and Experian. They all issue a score to you, and it's called a FICO score. The FICO was actually invented in 1987, and it essentially is the credit bureau agency's tool to assign credit worthiness. Okay. Now, one thing that you may notice is that Credit Karma and some other agencies like Credit Karma have their own scores. Okay, they use what's called a Vanguard scoring system, which is a little different. Now, what we hope in all of this is that all the scores should fit in the general ballpark together. That's not necessarily always the case. But we're going to talk a little bit about what goes into your credit score. Now, out of everything that you take from today, one thing I want to impress upon you is credit history and credit scores, because there's 2 major components that go into your credit score, and it actually accounts for 65% of your credit score. And the first thing is your payments. Do you make your payments on time? And when I say on time, I don't mean that if your payment was due the 10th and you paid it the 12th, that the credit card company issued you a late fee. That is not considered late to a lender. You are late if you are over 30 days delinquent on a bill. Okay, and then they will essentially mark that as 30 days late or 60 days late, and in 30-day increments after that. Okay, so the first thing they're going to look at is your credit history. How have you paid your past debts? The other portion, or the other component that goes into 65% of your score, is how much you actually have borrowed against your credit limits. Okay, so what that means to you is that if you have a credit card with $1,000 limit, it actually helps your credit score if you keep a balance of $300 or less. Okay. Now, that doesn't mean that if you owe $500 on $1,000 that it's going to hurt your credit. It does not hurt your credit. It just does not help boost your score. Okay. And just transversely like that, if you borrowed more than $1,000 on your $1,000 credit limit, that is actually going to negatively affect your score and bring your score down because of that. But those 2 major components, your payment history and how much you owe on your credit, constitutes 65% of your score.
Yeah, I agree. I mean, keep it simple, right? There's other things that factor in, but those are the 2 big ones. If you spend your time worried about those 2 and not the other 3, then yeah, you're going to get the result I think you're looking for. Great point.
So next, we're going to talk a little bit about an appraisal, or the market value of your home, because a home appraisal is not the same as a home inspection. They are different things. Okay. A home appraisal essentially is ordered by your lender during the loan process. All right. They are essentially contracting a third party, independent, licensed state appraiser to come out and evaluate your home. Now, when I say evaluate your home, what they do is they actually compare your home to homes that are in your area that are at similar size and stature and how much they're selling for. I cannot express this enough that an appraisal is just an opinion of value, okay? These people are licensed, but if I were to send 10 appraisers to your house, you may get 9 different values, okay? So it is their opinion of value based upon other houses similar to yours that sell within a close proximity of your property. Now, the difference here is that what is a home inspection then? Now, I will tell you this, that a home inspection is not required in order to get a mortgage loan. However, it is highly recommended. And the reason why is because a home inspection is like an insurance policy for you, the homeowner. Because a home inspector is essentially going to go in and test the major components of your home. One thing that you do not want to do is fall in love with a house and not get a home inspection. You move in, next thing you know, the furnace goes, or the air conditioner doesn't work, or the hot water tank goes. These are major components of your home. Now, a home inspector is not going to come in and fix any of these things for you. However, they are going to issue a report to you and say, listen, this hot water tank is 15 years old. You probably only have 1 to 3 years left of life expectancy on this. Or, you know, the roof was replaced 5 years ago. You probably have another 10 years of life expectancy on your roof. This is what a home inspector does, okay? So they look at the major components of your property and give you an estimated time of when you should expect to have to repair or replace these major components. So this is essentially a list of different lending products and programs. We are not going to necessarily get into all of them, but I essentially wanted to share this just from a standpoint of there are many, many products out there for first-time home buyers in every situation. And whether that's, you know, little money down to, you know, jumbo financing to specialty products like a doctor-only program. These are all things that are available. So the lending programs today are not necessarily the same as where we were a couple of decades ago. And they've kind of cleaned everything up since the mortgage bubble as well. So there are specific programs for everyone. Now, the last one I want to show you, that last bullet point where it says portfolio lending solutions. Now, you're going to notice that with different lenders and different banks, they're going to have different portfolio products. And all the portfolio products mean is that is a loan specific to that lender or bank. Okay. So for example, at Citizens, we have a portfolio product called Destination Home Mortgage. It is a mortgage product just offered by Citizens that is offered to first-time home buyers that you would be able to apply and qualify for up to $2,500 in grant money. So this is something specific to Citizens that no other lender offers. And that was my point to that.
Good.
Okay. So finally, here are the next steps. You know, we want to take a look and we want to review your buying goals and talk to me and kind of review that with me so we're all on the same page. You want to be able to get pre-approved or pre-qualified before you start going to look for that house. It's heartbreaking to find a house that you fall in love with before pre-approved and then find out that you can't purchase it because you're not approved for that. You know, one thing that I do with everyone is I review a copy of their credit report. These people that run these credit bureau agencies are humans just like the rest of us and can make mistakes. And that's something that you want to make sure that whenever, you know, you want to review that credit report, you want to know, okay, is it accurate, right? And then you want to also kind of start assembling some financial records or some documents that you are going to need in order to get qualified for your mortgage. These are things like tax returns or W-2s and pay stubs, asset information, banking, checking, savings, things like that. Okay. And that concludes actually my presentation.
Okay.
Are there some questions there, Jonathan, that I may not have touched on?
I wrote down some questions, so leave that screen up there, and so I've got a couple sets of. I got some quick ones, and I got some ones that are going to be require more thought. But so this is like the speed round for you, Dave, and this would apply to you. So, what process would you use to pick a realtor?
Oh, well, that is a fantastic question because
it's a speed round,
one
so it's gotta be quick.
So I would want to find a realtor that is willing to take the time and sit down and find out exactly what I need up front instead of just sending me emails of, here, look at this house and see, tell me if you want to go see it.
Yep.
I would want a realtor that takes the time to sit down and find out what I want before they start sending me links.
Good. So I'm going to assume you own a home?
I do.
15 or 30 year?
15.
Okay. Why?
Well, mainly because, and I bought a home that the mortgage payment was less than what I was qualified for.
Yeah.
And the reason why I did that mainly is because if you take a loan at 15 years, you're going to pay roughly about 45% less interest over 15 years than to stretch it out to a 30-year term.
Well,
and that was the main thing there.
Yeah. So for your home warranty or not?
Oh, that's another good question.
Actually,
yes, I did actually. And the main reason why I got one was because of my hot water tank.
Right. Okay. So this one, with pineapple on your pizza or no?
No pineapple.
Okay. And this one, I kind of know the answer to. Zoom calls, screen on or screen off. So I know the answer on that.
Screen off.
David, I have a question. This is Jason from MVI. I have a quick question for you. So I'm trying to figure out how to ask this. We see a lot of people in our area who are what they call unbanked. They don't have a regular relationship with their banker. Should you have, if you have a local bank that you work with, is that where you should start your mortgage application process?
Absolutely. I would recommend that highly, and mainly because a lot of banks, even Citizens, will offer a discount in interest rate to someone that banks with them. For example, you can actually receive an 1/8 lower interest rate at Citizens than anyone else if you choose to have your mortgage payment deducted from your Citizens checking account. So yes, that is an absolute perfect place to start.
Yep. Okay. So some of my longer questions, David, are: have you ever had a buyer buy a home, a HUD home or a foreclosure home? Did you ever help someone finance that?
Yes, I have actually had multiple cases of that, and every scenario is different. So the one thing is that with HUD homes or foreclosed homes, one thing that you need to be very cognizant of is, in some cases, those properties need to be rehabilitated in some way.
Okay.
And that is going to limit some of the loan options that you have available for purchasing these properties.
Okay. So some of the big ones that we talk to people. Sometimes they have collections on their credit report. They have an old credit card or an old loan that they didn't pay. What what's it like there at Citizens? Is there a number? And then we'll touch on medical too, so that might be different. But do you have do you see? Is there a pattern that you see that maybe you can share with people?
There's a good rule of thumb when it comes to collections. Okay, and normally that is if you have a total of $2,000 or less in collections, we're going to ask for explanations. Okay. However, when you start to exceed that $2,000 mark in collections is when we want to see some of them paid off. Okay. So that line in the sand there is about $2,000. And that is derived from a couple different loan programs that they have just kind of piggybacked on the guidelines for. But medical collections are different entirely. Okay. So a medical collection is not something, yes, it may affect your credit score, but it is not necessarily going to affect your lending abilities just because of the way our healthcare system is set up in the United States, that everyone, regardless of whether you have insurance or not, can walk into an emergency room and get help. Okay, so
if I'm hearing you correctly, you're saying if there's $3,000 in medical collections, that's different
that's
than
not,
2,000.
yes.
Okay.
Yes. So so those medical collections, of course, we're going to ask for a reason behind it. You know, were you hospitalized? What happened? Right. Yeah. We're going to ask those things. But for example, if you have, $3,000 in medical collections, we're not going to ask you to pay them. Yeah. Whereas where it was with a credit card or a repossession or something like that, then yes, we're going to ask those to be paid down.
Okay. And so similar on that same kind of track, student loans. And so I know student loans are really tricky right now because there's no payments being required. So what happens now with student loans, and what happens in the future when we go back to paying our student loans as far as mortgage lenders are concerned?
Okay, so this is a great question because it's huge right now with student loans. So there are, for example, we talked a little bit about government loans and FHA and veterans loans. So these government loans are going to take, for example, if your loans are in deferment, they're going to calculate a payment for you. Okay, even though technically you have $0 due because you're in deferment, they're going to use a payment to qualify you. Now, these government loans are going to qualify you at 1.5% of your unpaid balance. Okay, so if you owe $10,000 in student loans that are currently in deferment, a government loan is going to qualify you on a $150 a month payment. Okay.
Yeah.
Now, the difference is there's some other programs, conventional agency products and things that do not do that. They do not use 1.5%. When a loan is in deferment, they will use just 1% of that balance in order to qualify. Okay. So that same $10,000 student loan balance, a conventional product is going to only qualify you with a $100 payment for that instead of $150. Now, go ahead. I'm sorry.
So unfortunately, during COVID, you're actually placed into a disadvantage qualifying for a home loan. Is that kind of your sense?
Well, so there's other ways.
You'd be on your IBR payment or you'd be on your regularly scheduled payment.
Right. So there is other ways to supersede these deferred payment options. Okay. And what those are, because if someone tells me, guess what, I'm not going to charge you interest and you don't have to pay nothing for a year, there's other things that we could be doing with that money, right? But in some cases, that 1.5% or that 1% is more than what the loan that you have in payback is. Yeah. So what that means to us as far as qualification goes is that even if the loan is in deferment, if your federal student loan company would issue you a letter or a note or at least a statement showing that, you were on a 20-year payback plan for this $10,000 and it's $72 a month, we're going to use that $72 to qualify, even if you are in deferment currently. Okay, so there are some ways around that. Yes.
But they require a little more work than, say, just pulling a credit report. Good. So I saw a question. I saw a question come up here, David, and it talks about financing repairs. Western Pennsylvania. We've got some great homes. Some of them need some possibly additional work. Is there solutions for something like that?
Yes, there is. There's a lot of different programs that we can look at for doing that. So it depends on how much work you want to do to the property, right? We can go all the way up to construction to perm, and essentially have general contractors give estimates to be able to put an addition on, or whatever you're looking to do, all the way down to FHA 203K loans, which are essentially rehabilitation loans for properties that are a little, neglected. Okay, so there are options from, I want to say the lowest is, I believe, $15,000 to $20,000, all the way up to, you can, as long as you're not making a white elephant, you can construct anything essentially you want, up to the millions of dollars. So there are options that fit all along that spectrum. But I will tell you, because one thing that people talk to me about a lot is the fact that they want to buy this house, but they want to put, a new kitchen in it, for example, and that new kitchen, kitchens aren't cheap. So, I mean, it could be a lot of money, and they want to be able to rehab that property. But one thing that not everyone understands is that if it costs you $30,000 to do a kitchen, that doesn't mean that your property value is increasing by $30,000.
Right.
And that's where we kind of run into, I want to be able to do this, but at the same time, and we talk through it.
Right. So I have one more question for tonight, and and I'm a big believer that the people out there, when you're applying for a home loan, you have some control. What is in an applicant's control to try to make their process through the mortgage lending system easier or better?
Okay. Probably the easiest thing is that with every lender, not just with Citizens, your mortgage lender is going to provide you a checklist. Okay. Whether it's with Citizens, regardless of what lender it is, you're going to get a checklist. And on this checklist, it's going to list all the things that you're going to need to collect and do. This is going from signing federal disclosures to collecting your pay stubs, your asset statements. The best thing I can recommend is to have that stuff organized, because there's nothing better than having your purchase contract in one hand and a folder with all your stuff in the other hand, and being like, here you go. I would like to get my loan now. Right. And that saves a lot of time and aggravation, because if you're prepared up front, the lender is not going to come back to you in 3 weeks and be like, oh, I need X and I need Y and I need Z. And then you're scrambling around looking for this stuff. And it can be frustrating. There's a lot of, stress that goes into purchasing a house. So, and there's a lot of different moving pieces. So we try to do whatever we can to mitigate that stress and make it as smooth as possible. So that is one thing that can be done that would help.
And I add in there that, if Citizens ask for X, Y, and Z, that you send it back as X, Y, and Z, and not Z now and X, Y later, because it really makes a difference in working the papers. Give it back the way that they asked for it. So, you know what, David, you're a wealth of information. Certainly sounds like you've got some good tools or products out there to help our buyers. Encourage anyone that might be interested to reach out to you and see what's possible with you and with Citizens Bank. And on behalf of MVI, thanks again for helping us this evening. And I know things have been busy for you, and so sharing your time with us is much appreciated. So. To everybody out there, if you have updates that you want to share, if you have questions for me, call me. You can see David's information, his cell phone number, and he's real responsive as far as getting back to you to your questions. So thank you, everyone, for coming out tonight. We're going to have another Home Buyer Club March 4th. Be on the lookout for that, and we'll post some stuff on Mon Valley Initiative on our Facebook page to let you know about that. So again, David, thank you so much. We appreciate your time in helping us.
Oh, thank you for the opportunity. It's been great.
No worries. Thank you, everyone.